If you were looking to make a bulletproof investment over the last 2 decades, where would you put your money? Gold, the S&P 500, Bitcoin? While Wall Street suits spent years sweating over stock tickers and market volatility, an entirely different breed of investor was quietly beating the market from their garage. They weren't trading shares, they were trading plastic. Welcome to the bizarre, highly lucrative world of Lego investing, where a box of childhood toys can yield better returns than traditional financial assets. Over the past 20 years, retired Lego sets have maintained an average annual return of roughly 11%. That is not just a fluke. It is a consistent, resilient economic phenomenon that has outperformed gold, bonds, and many major stock indexes. This isn't about selling a bucket of your old, scratched childhood bricks at a garage sale for $10. This is a highly sophisticated secondary market driven by pristine, unopened, retired sets. Once the Lego Group stops production on a specific model, a ticking economic time bomb begins. Supply drops to absolute zero, while demand from nostalgic adults with high disposable income skyrockets. It transforms a simple children's toy into a scarce, tangible commodity. But how did a company that nearly went bankrupt in 2003 transform its product into the world's safest financial asset? Today, we are cracking open the vault on the Lego monopoly. We will explore the psychology of scarcity, the economics of nostalgia, and the precise mechanics of the brick market. Make sure to stay until the very end, where we will break down the crucial financial lessons this plastic empire can teach us about real-world investing. Let's build the story from the ground up. To truly understand how Lego became a financial powerhouse, we have to travel back to 2003. Back then, the Lego Group wasn't a powerhouse, it was a corporate ghost town. The company was drowning in nearly $800 million of debt, and sales were plummeting 30% year over year. In a desperate bid to compete with rising digital video games, Lego had lost its identity. They began manufacturing overly complex, specialized pieces, abandoning the simple, universal brick system that made them famous. The company was bleeding cash, overcomplicating its supply chain, and staring down the barrel of total liquidation. It was the ultimate corporate crisis. Enter Jørgen Vig Knudstorp, a brilliant young ex-McKinsey consultant who was appointed CEO in 2004. Knudstorp pulled off one of the greatest corporate turnarounds in modern history by doing something radical. He went backward. He slashed the number of unique Lego components from 13,000 down to 6,500, drastically lowering manufacturing costs. He refocusing the company's philosophy on the core, timeless brick. More importantly, he realized that Lego wasn't just a toy for children. It was an artistic medium for adults. By tightening production and mastering the supply chain, Knudstorp didn't just save the company, he inadvertently laid the groundwork for the modern secondary market. He instituted a strict life cycle policy for every set produced. Lego would no longer keep products on shelves indefinitely. They created an artificial cycle of birth, life, and retirement for every single box. By controlling the supply with absolute discipline, Lego set the stage for an accidental economic miracle. The secret source of Lego's immense financial stability boils down to a fundamental economic principle: artificial scarcity. Unlike central banks, which can print more currency, or toy companies that pump out the same action figures for decades, Lego operates with ruthless temporal discipline. Every single Lego set has a predetermined expiration date, known in the community as its EOL, or end-of-life date. Typically, a set enjoys a shelf life of just 18 to 36 months. Once that window slams shut, the molds are retired, the production lines are reconfigured, and that specific set vanishes from retail store shelves forever. This creates a fascinating market dynamic. In traditional economics, if demand for an item surges, the manufacturer simply ramps up production to reap more profits. Lego, however, sticks firmly to its retirement schedule, regardless of lingering consumer hunger. When production stops, the supply curve goes completely vertical. It becomes perfectly inelastic. No matter how much money someone is willing to offer, the Lego Group will not print another copy of that specific retired set. From that exact moment onward, the secondary market takes full control. The total global inventory of that pristine factory-sealed box can only decrease over time as people buy them to open and build them. As the circulating supply of sealed boxes steadily shrinks, even a flat, stagnant level of demand will inevitably force the market price upward. It is an engineered supply shock that occurs like clockwork hundreds of times every single year. Why does anyone care enough about retired plastic bricks to pay thousands of dollars for them? The answer lies buried deep within human psychology, specifically in an economic concept known as the nostalgia premium. The primary consumer of high-end investment-grade Lego is no longer the 7-year-old kid looking for an afternoon toy. It is the 35 to 50-year-old adult seeking to reclaim a piece of their childhood. Adults who grew up playing with Lego now find themselves with significant disposable income, high-stress jobs, and a profound desire for offline, tactile escapism. Lego recognized this shift early on and masterfully capitalized on it by introducing products specifically engineered for adults. They launched the Adults Welcome marketing campaign, packaging sets in minimalist black boxes and increasing the complexity and piece counts into the thousands. By securing premium, multi-generational intellectual properties like Star Wars, Harry Potter, and vintage automotive brands, Lego bridged the gap between toy and high-end collectible. They transformed their product from a plaything on a bedroom floor to a sophisticated centerpiece for a modern living room display. When an adult purchases a retired set on the secondary market for triple its original retail price, they aren't just paying for the physical ABS plastic. They are paying for an emotional time machine. They are buying back the exact feeling of opening that box on Christmas morning 20 years ago, or finally owning the massive model their parents couldn't afford back then. Because emotional longing is completely decoupled from logic, the nostalgia premium creates an incredibly price-inelastic consumer base willing to pay almost any price. Not every box of Lego is destined for financial greatness. Just like stock picking, Lego investing requires deep analytical scrutiny to separate the duds from the multi-bagger returns. The first rule of the brick market is absolute structural integrity. The set must be brand new in box, sealed, and in mint condition. A crumpled corner or a broken factory tape seal can instantly slash a set's future collector value by 30% to 50%. Serious investors treat these boxes like fragile fine art, storing them in climate-controlled dark rooms away from harmful UV light that can yellow the plastic and fade the packaging. Beyond physical condition, the ultimate value driver within a Lego set is often its minifigures. These tiny, 2-inch plastic characters are the true micro-commodities of the Lego ecosystem. Sets that contain exclusive, highly detailed characters that are never reproduced in any other cheaper sets often see their value skyrocket. In many cases, the collective market value of the individual minifigures inside a box can actually exceed the original retail price of the entire set on the day it retires. Historical data shows that specific themes consistently outperform the market average. Licensed themes with obsessive, multi-generational fan bases like Star Wars and Lord of the Rings are legendary performers. However, homegrown, unlicensed Lego themes targeted exclusively at adults, such as the highly detailed modular building series or the fan-submitted ideas line, often yield even higher percentage returns. These sets are produced in smaller quantities, making their eventual retirement an absolute gold rush for savvy investors. The Lego marketplace doesn't operate out of dark alleyways or chaotic flea markets. It is an incredibly sophisticated, highly organized global digital economy. At the epicenter of this financial ecosystem sits Bricklink, the world's largest online marketplace dedicated entirely to Lego products. Purchased by the Lego Group themselves in 2020, Bricklink acts as a specialized stock exchange. It tracks historical transaction data, current price averages, and global supply and demand metrics for every single part, minifigure, and sealed box ever manufactured. On this platform, and secondary platforms like StockX and eBay, investors can monitor market trends with the same precision as a Wall Street trader. They analyze price guides, that show what an item actually sold for over the past 6 months versus what sellers are currently asking. This level of transparency eliminates guesswork. It allows investors to spot market inefficiencies, track price consolidation after a set retires, and precisely calculate their potential return on investment before spending a single dollar. Operating in this secondary market, however, requires tackling distinct physical logistics. Unlike digital stocks or cryptocurrencies, physical inventory demands storage space, insurance, and shipping infrastructure. Successful Lego investors must account for selling fees, shipping costs, and packaging materials, which can eat into profit margins. Yet because the market is filled with highly passionate, dedicated collectors rather than speculative day traders, Lego prices rarely suffer from the extreme, sudden crashes seen in traditional financial markets. For a long time, traditional financial analysts laughed off the idea of Lego as a serious investment asset class. But the laughter stopped when the hard data finally came to light. In a groundbreaking academic study titled Lego, the Toy of Smart Investors, researchers from the Higher School of Economics analyzed the prices of over 2,300 sealed Lego sets from 1987 to 2015. The empirical evidence was staggering. Lego investments delivered an average real return of roughly 11% per year. Even more impressive was that these returns were completely uncorrelated with the broader stock market. This lack of market correlation is an investor's dream. During the devastating global financial crisis of 2008, while the S&P 500 plummeted and wiped out trillions in retirement savings, the secondary market for Lego remained completely unfazed. In fact, many retired sets actually gained value during the recession. Because the asset is fueled by nostalgic adults and collectors rather than institutional hedge funds or speculative macroeconomics, the brick market operates in its own insulated financial microclimate. Furthermore, the study revealed that Lego returns are not heavily dependent on the size of the set. While massive, expensive sets like the Ultimate Collector Series Star Wars models bring in huge absolute dollar profits, smaller, inexpensive sets often yield the highest percentage gains. A small $20 battle pack can easily triple in value to $60 within 2 years of retirement, representing a 200% return. This low barrier to entry democratizes the market, allowing anyone with a little bit of extra cash and some shelf space to become a highly successful alternative asset manager. While the numbers sound incredibly enticing, Lego investing is far from a guaranteed get-rich-quick scheme. It carries distinct physical risks that digital assets simply do not possess. The biggest enemy of a physical portfolio is environmental damage. If a water pipe bursts in your basement or a fire breaks out, an entire 5-figure Lego portfolio can be instantly ruined. Even worse, pests like mice can chew through cardboard boxes, and subtle humidity changes can cause the factory glue seals to dry up and pop open, instantly wiping out the box's sealed premium. The second major risk is market intervention from the Lego Group itself. Lego is, first and foremost, a toy manufacturer, not an investment fund. If demand for a retired set or a specific exclusive minifigure is high enough, Lego reserves the absolute right to re-release that identical set or character back into the market. A prime example occurred when Lego re-released the legendary Taj Mahal and the Saturn V rocket sets years after their initial retirement. This sudden flood of brand new retail supply instantly crushed the secondary market prices of the original versions, catching speculative hoarders completely off guard. Finally, as the market has grown more lucrative, it has attracted bad actors. Counterfeit sets and highly sophisticated fake minifigures manufactured overseas have flooded online auction sites. Unwary buyers can easily fall victim to purchasing high-quality fakes packaged in replica boxes. Navigating these pitfalls requires meticulous quality control, proper climate-controlled storage, and an acceptance of the fact that unlike liquid stocks, you cannot instantly liquidate a garage full of plastic boxes at the push of a digital button when you need fast cash. As the financial value of Lego skyrocketed, the asset class caught the attention of an entirely different crowd: organized crime rings. Because Lego sets are high value, Physically untraceable and incredibly easy to liquidate for cash on secondary marketplaces, they have become a prime target for sophisticated retail theft syndicates. Across the globe, police departments have begun dismantling massive, coordinated Lego rings. These aren't petty shoplifters. These are organized criminal operations using advanced tracking methods, inside connections, and hidden warehouses to steal and distribute millions of dollars in stolen plastic bricks. The scale of these heists is jaw-dropping. Law enforcement agencies have executed raids recovering single stashes of stolen Lego valued at over $300,000. In Southern California, a major sting operation dismantled an organized group that was systematically targeting major retail stores, wiping shelves clean of specific high-yield investment sets and funneling them directly into a network of black market fences. These fences would then rapidly flip the stolen goods to unsuspecting collectors online at a slight discount, laundering the cash through legitimate-looking digital storefronts. For regular hobbyists and investors, this criminal underbelly introduces massive counterparty risk into the ecosystem. Online marketplaces have seen an influx of sophisticated exit scams. Malicious sellers set up temporary accounts, offer highly sought-after retired sets at prices just below market value to trigger fast impulse buys, and then vanish into thin air once the payments clear. Navigating this landscape requires investors to develop a sharp eye for fraud, double-check seller histories meticulously, and realize that when an investment asset becomes as valuable as gold, it inevitably attracts the same element of greed and crime. The incredible rise of the Lego secondary market is more than just a quirky trivia fact for toy enthusiasts. It is a masterclass in fundamental market economics. It proves that value is not dictated solely by traditional financial institutions, central banks, or Wall Street analysts. Instead, value is generated wherever human desire, strict emotional nostalgia, and absolute physical scarcity intersect. By studying how a simple Danish plastic brick transformed into one of the world's most resilient and reliable alternative asset classes, we can extract 3 profound financial lessons applicable to any investment portfolio. First, Lego teaches us the unmatched power of true, uncopyable scarcity. When an asset's supply is strictly capped and entirely immune to sudden dilution or overprinting, its long-term value becomes fundamentally protected against inflation. Second, it highlights the immense economic value of the nostalgia premium. Human emotion, collective cultural memories, and deep passion are incredibly powerful market forces that can easily decouple an asset's price from its baseline utility. Finally, it underscores the importance of alternative diversification. Spreading capital into non-correlated tangible assets can provide an invaluable financial safety net when traditional equity markets face severe economic downturns. Lessons learned. Summary. Through the lens of the Lego monopoly, we have uncovered critical investment principles that apply far beyond the toy aisle. The power of rigid supply dynamics. True scarcity occurs when production stops completely, creating an inelastic supply that naturally drives up value as circulating inventory diminishes over time. The economic value of human emotion, nostalgia, and passion are powerful, logical drivers of asset valuation. When consumers are emotionally attached to a product, their purchasing behavior becomes highly price inelastic. The strength of non-correlated assets. Alternative investments that operate independently of major stock indexes offer vital diversification, maintaining or increasing their value even during severe global recessions. Physical logistics matter. Tangible portfolios introduce unique physical challenges, including environmental vulnerabilities, storage costs, counterfeiting risks, and lower liquidity compared to digital assets. We want to hear from you. Would you ever consider allocating a portion of your savings to a portfolio of sealed plastic bricks? Or do you prefer to stick strictly to traditional stocks and bonds? Let us know your thoughts in the comments below. If you found this deep dive into the secret economics of Lego both informative and entertaining, please hit that like button, share this video with a friend, and subscribe to the channel right now. By subscribing and turning on notifications, you make sure you never miss out on any of our future deep dives into the hidden financial forces shaping our world. Thank you for watching, and we will see you in the next video.